Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Heidi Crebo-Rediker of the Council on Foreign Relations writing, final days come down to turnout. Does the floating island of garbage insult remind Puerto Rican voters in swing states of Trump's poor treatment of the island after Hurricane Maria? Seeing massive backlash, but will they vote on it? This could make or break the election. Heidi joins us now for more. Heidi, just elaborate on that. Your thoughts on the last few days, this word garbage and how it may shake up this election race.
So I'm paying a lot less attention to the Trump comments on garbage than what happened at Madison Square Garden on the floating island of garbage comments. And I think the reason that I'm thinking that is because right now it really does come down to turnout. The polls are razor thin in the states that matter, in the communities that matter. And so if you're undecided and you haven't voted yet, what's going to make you decide? If you're ambivalent and you need an actual reason to vote, is what Trump's talking about going to actually, turn the dial for you? Because I think his supporters are pretty, they're pretty committed, and if they haven't voted already, they're probably going to vote for him regardless of the garbage comment. For the Puerto Rican community, I think it's really a wild card. That's what I'm paying attention to, because that comment at the event at Madison Square Garden, even though Trump did not make it himself, he never apologized for it. And it insulted and reminded Puerto Rican voters in swing states of Trump's poor treatment of the island after Hurricane Maria, about the way he delayed aid. And then when he got there 2 weeks after a devastating hurricane, he threw a bunch of paper towels at the crowd. And so, it's a question of whether or not these very large Puerto Rican, specifically, populations in these swing states. Anne-Marie was talking about in Pennsylvania. 500,000 Puerto Ricans live in Pennsylvania, in a state that Joe Biden, when he won last time, it was on 80,000 votes. So, we're talking about very large numbers who could decide they're really not very happy about what they saw more than 4 years ago in the treatment of Puerto Ricans. It was insulting, and it could move the dial.
Heidi, of course, the flip side of this is a large part of individuals can also be turned off on the President of the United States comments that half of Trump supporters are, quote, garbage. And Kamala Harris is now having to clean up Joe Biden's comments. Is he doing more damage to her every time he goes out and speaks?
So I think that it was unfortunate that he used that language, and it obviously harkened back to comments that were made during the campaign with Trump and with Hillary Clinton. So but again, if you are going to, it's really about a narrow swath of voters and what can motivate them to change their decision, or if they are turned off of politics and just want to sit this election out, what can make them actually get up out of their house and actually cast that vote. And I don't know if President Biden's comments, which we're not re-electing President Biden, if they actually are going to move the dial for that very important group of undecided or ambivalent voters.
Heidi, how do you think she sticks the landing when it comes to the economy? The FT this morning calls Kamala Harris's other electoral foe inflation. This continuously shows up in polls. How does she distance herself in these final days in these swing states from the current administration when it comes to inflation?
So it's a hard narrative. I mean, people are generally hurting from the fact that that goods, the everyday goods cost more than they did pre-COVID. I guess what I would suggest is that it's not just looking back over the last 4 years, it's looking forward to what a blanket tariff policy across all, the whole world of 10 to 20% and 60% on China, what that actually could mean for inflation. Well, it's probably those kind of tariffs are inflationary. Tariffs we've had for many years. We know what they do. They're inflationary, and it depends if they are tactical and targeted versus across the board. I don't think that voters really understand that Trump saying that he is tariff man can get into the Oval Office day one and actually, without any checks and balance, he can actually implement his across the board tariff policy that would be inflationary. And what does that mean? It means that it's going to impact consumers, intermediate inputs, like for every business that's part of a supply chain. You can count on retaliation. You'll blow up all of our FTAs with countries, and our allies will push back pretty heartily against us in a world where we actually need our allies. We don't need to alienate our allies. So I think that there are, it's not only inflation, but you could have both, commercial inflation and geopolitical reactions that would be highly negative. What does the Fed do? We're talking about the Fed for next week. What does the Fed do if they're facing, challenges to inflation on one side, and then spillovers that might impact credit markets, mortgages, company borrowing? You're going to be in a very different dynamic if we come January and you have massive across-the-board tariffs imposed.
Heidi, what are you watching in the final days of the election race?
So, again, the markets are not a good predictor of who's going to be in this election, who's going to win this election. But I do think that the fact that you've had a lot of women show up in early voting, you've had, and the gender divide plays very much into Harris's camp. The fact that you do have these narrow populations who can actually really determine the election one way or the other, and we just don't know. Anyone who tells you they know who's going to win doesn't know what they're talking about. We are neck and neck right now, and we're not going to know until the votes are finally counted, and that might not be next Tuesday, might not be next week.
Don't say that, Heidi. I'm hoping it's all over by then. Heidi, appreciate your time, as always. Heidi Crebo-Rediker there of the Council on Foreign Relations. Seth Carpenter, the chief global economist at Morgan Stanley, is with us around the table. Seth, 2:16. Should I ignore the random number generator tomorrow morning at 8:30 Eastern if it's weak, based on the fact that jobless claims are this low?
Absolutely. I think if it's weak, even if today hadn't been 2:16, you would have still ignored the random number generator. The bottom line is the labor market's actually pretty healthy. I think the 2:16 is consistent with that. I think the fact that you're getting a little bit of a drift up in the continuing claim says, boy, maybe people aren't getting rehired as quickly, but there's not a wave of layoffs, and that for me is what's fundamental.
The hurricane impact doesn't seem to be there. Last week already predated, those numbers were actually below the hurricane impact, the pre-hurricane hit. And then you've got the strikes, so we're not seeing any real mushrooming into the economy off the back of these strikes either. How do you frame a downside surprise like this? I'm still scratching my head. What are we doing here down at 2:16?
I mean, this is the question we keep asking ourselves. So this whole expansion, we've been on the constructive side of things. When it was hard landing versus soft landing, we said soft landing. When it was late summer and we got a weak jobs report, we said don't worry about the economy is strong, and people threw rotten garbage at us and told us that we were ugly and stupid. If we've been wrong, it's because we've been insufficiently optimistic, and I think these numbers are really consistent with a super healthy job market.
So then why should the Fed cut rates next week?
I think the Fed's view on this is going to be inflation's coming down. It's clearly off its peaks. It's trending down. The number we got today, there's a little bit of sort of wobbling around in it, but I think the trend is still pretty clearly down. And so from their perspective, you can still lower rates from where we are, be restrictive, try to take a little bit more steam out of the economy without jeopardizing the prospect of growth. So I think they're trying to walk this very fine balance of being tight but not too tight,
I'm looking right now at the PCE data. Within all of this, you see a strong labor market, and you see PCE inflation data that came in slightly above expectations. At what point does that get people's attention? At what point do central bankers start caring about the inflation rate again?
Well, I think we saw, for example, in Q1 of this year, they really cared a lot. Everyone was gearing up for them to start cutting in the beginning of the year, and then Q1 data were strong, surprised to the upside, and they pushed off the rate cuts, obviously, until September. So I think it needs two things. One, a couple more months of upside surprises, because we really have had things come down. You'll remember Chris Waller from the Fed said the reason he went for 50 basis points instead of 25 was because inflation data had surprised him to the upside. So a month or two to the upside isn't going to change the fundamentals. And then you need it to be compositionally the stuff that we know has a lot of inertia, like housing inflation. That sort of wobbled for a little while. It wasn't clear, and then it came down again. And I think as long as those really core pieces, no pun intended on inflation, as long as those really central parts of inflation keep trending down, then I think they're going to feel comfortable.
Most voices on the FOMC said they didn't want to see deterioration in the labor market. That was part of their reason.
Mission accomplished.
Right. Well, seriously, what do they come out and say in terms of the assessment of the labor market on Thursday?
I think you're going to see words along the lines of solid, robust, healthy. The unemployment rate is 4.2%, so it's up off of the lows. We had an unemployment rate that was around 3.5%. So I think you have to be able to say that there's been some cooling. If you look at the job openings data from where it was when the labor market was tightest, you have to say there's been some cooling. So I think in that regard, they're fine. The pendulum had swung a bit too far. People got a little bit too breathless over a couple of months of jobs data. We're not deteriorating.
Let's talk about the other big event next week, and that's the election. You're spending a lot of time talking to clients, and something that was interesting in your notes is there seems to be a differential for clients that are in the United States and those abroad. And what is that centering around?
So I think one of the key parts is tariffs, right? So the election is going to have, from a top-down macro perspective, three key policy implications: tariffs, immigration, and fiscal policy. And to a person, when I'm overseas, all investors are convinced former President Trump, if reelected, will go back to putting in tariffs, and there's just no doubt in their mind. I think there's a bit more debate and difference of opinion on this side of the Atlantic. People who think either, oh, well, it's going to be a negotiating tactic, or if in fact he announces it and it ends up being bad for the market, for the economy, then it won't come through. So I think that's an interesting dichotomy of views.
You've got to work out who wins. You've got to work out the makeup, the division of government, if there is one, if there's a sweep, if there's not a sweep. Then you've got to work out whether the promise becomes reality. Once you've got there, okay, let's just deal with this. If you take everything that's been said on the campaign trail, is it a stagflationary proposal from the Trump side? Is that how you see things at Morgan Stanley?
Absolutely. If you were to literally take everything that's been said, let's just deal with tariffs that we were talking about before. If you had, in January, 60% tariffs on everything imported from China, 10% tariffs imported from everything around the world, I think that pushes up inflation, and that probably happens first. The numbers we've calculated are in the 0.9 of a percentage point kind of boost. But the drag to growth could be as much as 1.5%. I mean, I think it really is important. And that ignores the immigration side of things. The reason we had 3+% growth for a year and a half, and inflation continuing to fall is because we've had this big add to the labor force.
How different is the Harris proposal as things stand when you go through that big 82-page document on the website, 82 pages long? Yep. When you go through that, how different is the proposal?
Well, I mean, I think, again, going back to tariffs as an example, I look at what the Biden administration has done. They put tariffs on electric vehicles coming in from China. Boy, that's almost entirely rhetorical, right? There aren't that many electric vehicles that have been imported in the United States from China, and so it's not going to have anywhere near the same effect. We can look back to 2018, 2019, and see the hit to industrial production, industrial output from that wave of tariffs. I think there's a pretty meaningful difference.
Market participants are running around saying, not a big deal, we'll work through this, stocks go up and to the right. That's what the chart always looks like over a long time. Do you think this does have the potential to really redefine things years out, this election? Do you think it's that important?
I do think so. The rejiggering of the global supply chain, the rejiggering of global economic interactions, that's real. That's been going on for some time. It got accelerated with tariffs. I think another round of tariffs, another trade war could in fact accelerate that rejiggering in ways that maybe we can't fully anticipate.
Seth, it's good to see you, as always. Thank you, sir. Good luck over the next week. Seth Carpenter there of Morgan Stanley, going into payrolls tomorrow. Sitting in the seat, Lindsay Rosner of Goldman Sachs Asset Management. Lindsay, good to see you.
Good to see you.
Got to start with this economic data. Is there anything not to like? Jobless claims, GDP, looks pretty good.
Looks good, looks fine, looks quiet. I think that's something that's a big relief right now. There is a lot of volatility priced into the market. If you look at the MOVE index, which is looking at rate vol over October, it's gone, like you were saying, top to the right for equities. It has made a move for sure in October. This is a good day of quiet. I think the event will actually be month end at the end of the day, not the data this morning.
Walk me through why.
So there's actually going to be a pretty decent rebalancing. So if you think about how bonds have performed in October versus what's gone on with equities, you want to shift your portfolio given the outperformance in equities. You have the normal month-end extension, which happens always with indices in the bond market. So there has to be kind of this natural buying of duration, but there's going to be this additional, much bigger thing of asset allocation. Add equities into bonds.
So are you saying that essentially this is noise and it's the technical underpinnings that really will drive yields lower regardless of what happens with all of these different events next week?
Well, today's story is going to be the month-end story. The things that happen over the next week are actually big. Besides from the data prints, we've got auctions, we've got threes, we've got the bond. We have obviously the election, and then we lead up to FOMC. So not necessarily that yields are going to go lower for the rest of the week. I think we're in a moment of a lot of volatility between now and then, but today's movement, I think, is really month end.
Do you see a shift in the narrative, though, right now, where people have just been underestimating how strong this economy is? And that has been the theme again and again and yet again here as we wait for potentially weakness that may not show up tomorrow in the jobs report. Is there a sense that there could be a reacceleration in inflation in a more meaningful way? Is that starting to come back to the table in the discussions that you're having?
Yeah, and that's been a big explanation for what's happened with yields. I mean, the amazing thing is the Fed cut 50 basis points, and we're now 60-odd basis points higher across the curve. That is pretty tremendous, and a big part of that is a concern about inflation because growth just is that good. But I think on going forward, we've got a lot of noise that's going to happen in the next week, but things are going to calm down, and I think we'll have a lot more certainty. And the way we actually are talking with clients right now is that you've got a huge opportunity with this move up in yields. The economy is good. The Fed has the power to do what it needs to do. And where we were a month ago was much lower yields, or a little bit past that, earlier than September 18th, earlier than the cut was. You know, you're waiting on the Fed to see if they are going to go and how much they're going to go. Well, now you actually have an entry point of higher yields, and you know that the Fed's going. That's a home run, and this is a great opportunity to be in fixed income.
Is there a chance they skip, though, and push this decision to December?
There's always some probability around skip, but we think the conversation around skip is really something of 2025. We feel pretty good that the Fed's going to go 25 next week. They're going to go 25 again in December. That puts them in a really good spot. They've done some hard work at, chopping some wood there of 100 basis points. Then they can pause and survey what's going on.
They have to pause, right? Because policy in 2025, does anyone have any idea what that's going to look like?
We do not know right now. I think you're absolutely right. But they will start to have an inclination. We'll obviously know a lot more. We may not know on election day who's actually won and how everything else shakes out, but we'll know pretty soon and what those policies do look like. It's going to take time, though, to your point, to implement them. And so for us right now, I think a lot of people want to talk about how do you trade the election. It's not about trading the election, right? It's about where do you want to be from a long-term portfolio allocation. For us, we think it's really important from a strategic value perspective to get bonds into your portfolio. And we think there's no time like the present.
So Treasury is a big piece of that, given the rise we've seen in yields across the curve by about 50 basis points. High yield spreads are super tight. On a historical basis, 276 right now. How do you frame that for clients at the moment? What's the opportunity look like in corporate credit in America?
Corporate credit is tight, but I think what's so amazing right now is that you've got a ton of volatility in the rates market. We've had no volatility in the credit market. So what's behind that? So we start to unpack it. What's behind that is there's not a recession. Balance sheets are strong. Management companies are doing the right thing. But when you go underneath the hood of the car and look at what's happening in high yield, something that's flagging for us is just how well triple C's, so the lowest of low in high yield, have performed on the past month. That to us is a little bit of a complacency indicator. So not all those companies make sense, not all those balance sheets make sense, and it has been off to the races for triple C's. That for us says this is really important to have an active manager in this environment because, yes, maybe triple C's did well this month. Long term, there are a lot of companies there that aren't going to do well, and you want to make sure you're in the right spots.
How are you navigating? What are the right spots? I imagine there's an up in quality bias. What are the right spots right now in corporate America?
Right. For us, it's really kind of a curve thing and a quality thing. We've spoken before about we like the front end of the corporate curve. We think that that's going to do a lot better than the back end. So that's how we're positioned in terms of maturities. And then we are down in quality and investment grade. BBB companies are doing all the right things to stay investment grade. They don't want to be in high yield. And then in high yield, we're up in quality in those double Bs and single Bs and specific names that we like.
Do you expect more tech-related issuance coming into the fore, not necessarily tied to tech, but tied to some of the investments in the infrastructure around them that you expect them, and they're talking about having to make?
Yeah, there's definitely going to be capex, and it's interesting you bring up the capex expenditures on tech. That is actually back to areas of corporate credit we have to think about and be more cautious on, one of which is utilities when it comes to spending. That's a spend we're actually really concerned about in terms of the capex that's needed for going green. So that kind of the drivers of who needs to spend and for what, and are they going to be worthwhile projects, or are they really just going to be on a drain and regulatory? That really guides the sectors that we like and those that we stay away from.
It's a fascinating sector right now, that's for sure. Lindsay, it's wonderful to catch up with you, as always. Appreciate your time.
Thank you.
Lindsay Rosner there of Goldman Sachs.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.